We can talk about that and talk about it and talk about it, but it's difficult because of the behavior of individual investors. And I think the behavior now, and I'm sure a lot of your clients are looking for some form of income strategy, right? Because you have 10,000 baby
Right.
boomers, turning 65, the statistics. And this whole I want a high dividend income paying strategy. And I think people get confused that a dividend is like a coupon when it comes to a bond, but they're two totally separate. They're two totally different types of securities. Let's talk a little bit about what the pros and cons are, or more or less, why shouldn't people try to frame their foundation of their investment strategy in retirement on a high dividend paying stock strategy?
Well, I've written about 10 pieces on this subject on my blog at ETF.com. So any of your listeners want to go and learn more about this, you can go to ETF.com. There's a tab called Sections, and if you go to Index Investor Corner, and then you'll see all of the blogs that I've written. You can just look for the ones that have dividend in the name. But here's a really simple way to think about it. I was just having a debate today with a client who was saying, Larry, but hey, over the years, I've got these dividends and I reinvested them and I got more stock, and so I got this compound return. And I said, let me show you how wrong-headed that thinking is. So let's assume that that company, instead of paying you the dividend, never paid it. All right.
Yep.
Now, all you did when you paid the when you got the dividend, you took it and bought shares in the company. Your investment is exactly the same, all right, because the stock price drops by the amount of the dividend, because a company must be worth less by the amount of cash it just paid out. The stock drops. So if the stock was at 100 and you get $1 dividend, it's now 99. You buy that the shares at 99, and your investment's back up to 100 again. And so you're no different than me. I own the same company, if you will, that never paid a dividend. The only difference is you got paid the dividend and you paid
tax.
income tax on it. All right, and we're in exactly the same pace, but you got 15% less because you paid that, or maybe as high as 23.8 in the highest brackets. You paid the tax on the dividend. It makes no sense. Economic theory, financial theory, it's called Finance 101 if you want, is that dividend policy should not matter. And the academic research shows that stocks that have, say, the same price-earnings ratio have exactly the same returns whether you pay a dividend or not.
Well,
and as Warren Buffett said, by the way, he said, I don't pay dividends in Berkshire Hathaway, and if you want a dividend, just create your own. Just sell some shares. That's better. Buffett knows, dumb for him to take a dividend. Why does he want to pay taxes on them? Just let it continue to grow inside the firm. Very simple stuff. If you need the dividend, sell some shares. If the company, by the way, has excess cash and it doesn't need to can't find good investments, then what it should do is buy back the stock instead of paying a dividend, because now that pushes the stock price up. There are less shares, outstanding. And now what happens is you, in effect, get that in that if you have to sell stock to generate cash flow, you only pay a tax on the portion of the amount that you took that was a gain.
Right.
When you get the dividend, you pay a tax on the full amount. So it makes no sense for investors who are taxable. Much better if companies never paid dividends and instead always use the cash to buy back the shares. Unless they thought the stock was for some reason overvalued, then they could make a distribution and return your capital. But really, people's focus on dividends is a purely psychological one. Here's what I hear the most, Joe. When the market's down,
right,
I don't have to sell stock to generate the cash, right? I'm getting my dividends. No. The company, in effect, sold stock for you in the form of that dividend. They could have kept that cash, and the stock price would have been higher. You just sold and taking the dividend, That's exactly the way that you should think about it. You're disinvesting in the company. It's only your choice of the companies. That's all. But either way, you have disinvested. Your equity investment in that stock is now less by the amount of the dividend.
But that's the point. But I think most people don't get it. They think it's like a bond in a sense, right? If hey, I have a 3% dividend, right? So I'm going to get the 3% on the share price.
Right.
Versus no, it's not a bond. You are an equity owner of the company. So if the company goes down and loses money, you're going to lose too. Or if it gains money, you will gain. Versus a bond is a contractual agreement. So.
That's exactly right. They're just returning your own capital to you. And what people don't understand is that fact. Now, here's why that happens. Let's say you got a stock trading at $50 a share and they pay a 12-cent dividend. Well, you can't see it in the price. The stock price might have even gone up that day, but it would have gone up if you're paying, let's say, a 12-cent dividend. It would have gone up by 12 cents more than it went up that day. Right? If it hadn't paid the dividend. That's what they don't understand. So the noise of the market hides what's going on with the dividend.
So with all of these strategies, ETFs that are coming out and some package products, high dividend, you're just going to invest in high dividend or paying companies. Do you think that's all marketing?
I know it's all marketing. There's no rationale for it from a financial perspective, either in theory or from the evidence, as we said. And by the way, it's actually a really dumb strategy in my mind now, because you've got what we know as a crowded trade. By that I mean the zero interest rate policy of the Federal Reserve has pushed people who take this cash flow approach to abandon safe bonds and buy anything with yield in it, and whether it's risky or not. So they're buying junk bonds and they're buying dividend-paying stocks, right? And taking that yield and thinking of it as coupon, as you said. No, you're buying a very risky asset, which if we get another year like '08 could drop 40 or 50% quite easily, unlike the Treasury bond with that same 2% coupon. But what's happened, Joe, is this crowded trade, this money rushing in. Companies that were a high dividend payer, so paying today the average dividend, say, is 2%, so a high dividends may be paying 3% or more. The stocks that used to be high dividend payers used to be really value companies, and value companies had higher returns for the reasons that we talked about. They had a high yield relative to price because the price was distressed because it was a risky company. Now these same companies look more like growth stocks because everyone's been buying them up, so now their expected returns are much worse. So you got all of the risk of these stocks, but you're not getting the same expected premium you used to get historically. It's become, in my mind, a very dumb strategy.